stock ITC. Now let's talk call shorts in general. Now, the first thing you should do if your trade goes wrong, if it's a naked trade that you've taken, it's a put long or call short, book a loss. Like you don't have to fight that particular trade. Like when you have a position that has gone this drastically against you, fighting that trade most of the time is as good as creating a new trade. Like it's like, why are you in that trade? Is it because that you were already in the trade, that you want to continue managing that trade and have to come out of that trade only profitable? Are there no better trades that you can take? First thing, cut your losses, right? If you can't, and if you had a hedged position, then I'll talk to you about how you can adjust it. First kind of position that most people had on ITC was covered calls, right? They own ITC shares, or they're holding ITC future, or they had a deep in the money call option, and against that they sold a out of the money call option, right? Now I have some okay. So this particular person sold a call option at 220. Okay, so ITC 220 call option. He, assuming that he has sold it at previous close of 2.35, today is trading at 16. That's gone up 8 times. But let us say you have the underlying, you have actually achieved the maximum profit in the trade. So you should be happy that you've achieved if this was a covered call. And if you want to give delivery, give delivery. But this is the same problem with everyone who does covered calls. They don't want to give delivery. They wanted every month that premium. But when finally their call option went in the money, they don't want to give that delivery. I'm also that type. I also don't like giving delivery. But what I do is I keep a lot of my margin available so that I can come out of not giving delivery as well as the futures and option trade profitably, right? So, but for example, let's say you don't want to match this position. There is something you can do called a rollover. This is trading at 13. Assuming you sold it at 2 rupees and it's gone to 13, you are booking a loss of 11 rupees. So you need to collect 11 rupees. What do? Go to the next one. Go to ITC 230. You roll up. Now currently ITC is at 230. So this is the at the money call option. 230 October call option. You are getting about 12 rupees 45 paisa. What does that mean? You booked a loss of 11 rupees on your F&O position, and you have again sold this call for 12 rupees 45 paisa. So effectively then at that point, you, in case ITC goes down also, you have the protection of this call. And in case ITC continues to move up, at least you won't have given up your shares. And there is potentially another 12 rupees 45 paisa that you can get. This is called a rolling forward and rolling up. Now, depending on how much you want to be protected on a reversal, you can choose a higher strike or a lower strike. You can also roll forward, but generally it is preferred to roll forward and up to whatever is at the money or out the money. You don't want to roll forward and up into in the money because then basically you won't really be getting much extrinsic value. So that is the first part. For people who have covered calls, who had a fully hedged position that was actually going to benefit and they don't want to give delivery. Now, the second kind, there are people who have done strangles and ITC. Strangles and ITC is something that I personally never understood because ITC has such low IV and you don't want to strangle low IV. You want to strangle when there is expectation of volatility, not when there's absolutely no expectation of volatility. But let's take a look at this particular trade, right? So he shorted 205 put option of October and 230 call option of October at 215 and 275. Let me make this trade. Okay, how you would manage this trade depends deeply on how much margin you have. If you don't have any margin, cut this trade. Cut this trade, give up on it, forget about it, and book your loss. Like don't do. There are other things that you can do where you can now bring your put at the money and then all kinds of mambo jaban that can be done. But that's basically a new trade at that point. Why are you sticking to this trade? Okay, you think IV on ITC is very high. You short that IV. That can be a particular trade, but this trade, if you don't have additional margin, definitely it has to be booked and you have to book a loss on it. You should get out. Okay, now let's say you have a lot of additional margin. What is the first thing that you need to do? You need to control the bleeding on this call. So for that, you need to have additional put side credit. You need to be able to sell this particular put option. That is the first thing that you'll do. Because IV is high, you'll get some pretty good premiums. And then you need to probably add additional DK to this position. So you can add another straddle at basically martingaling your straddle at 230. You can add another straddle, or you can add a strangle if you want, where you look at the breakout level. So you can say 215 is the breakout level. So say 215 is the breakout level. You sell this put option and you sell call option, which is roughly the same price. Okay, something like that. Now you've sort of overpowered this trade a little bit with capital, and you can only do this in high quality. I mean, ideally, I do adjustments like this because most of the time I'm holding the underlying also. So an up move actually doesn't have too much risk for me. And if it goes to my lower break even, I don't mind buying it and then fixing the trade that way. So this is a way of sort of overpowering a trade and basically adding forcible amount of potential decay that you can get in the range. So this is one way it can be adjusted. Basically, to adjust your call, which is at the money, you will have to sell an at the money put, but the price at which you would have sold the straddle would be quite low. So you need to add additional straddles or additional strangles to do that. Now, in case you're expecting a move, there can also be stuff like you can add broken wing butterfly, but it's too late for that. Like after this kind of a move, after this sort of a situation, it's too late for you to actually make any real adjustments like adding a debit call spread or by moving up your puts at different point of time. It's too late. Your one premium has gone up 8 times. So either book the loss or you dump it with capital and you try and manage the trade. And stocks like ITC, you can do that. Let me go over one of the trades where I actually did this in this month. So this was my Reliance trade. I took this covered call position on Reliance when Reliance was at 2160. At that point, my first leg of the trade was selling this 2300 call option for 20 rupees. This position is losing me 1.12 lakhs just from my cover. Of course, you have to understand my shares have gained by that much. They have gained by a good 300 points almost. And so that being the case, I don't want to give delivery of my Reliance shares. It's my largest holding and I plan on never giving delivery of that. So I did similar things. So I basically moved up my puts, added positions that would give me additional decay in this range. Yes, compared to what was the initial margin required for this trade, which was somewhere around 3 lakhs or something. Now the margin required is 30 lakhs, right? But I've now ensured that my F&O position comes out in profit. If Reliance continues to go higher, actually my upside risk is zero because I'm holding the shares. If Reliance hedge lower, yes, around 2,300, I will have to purchase. I will purchase. That's not a problem. Against that, I'll again sell calls. I'll manage that position in that way. So yeah, there is a difference. That's also kind of why you shouldn't use all your margin to enter your trades. So let me go over another position where my covered call is bleeding and what I intend to do there. This Larsen position, Larsen is at 1721. I sold this call option on Larsen for 16 rupees when Larsen was below 1600. Now it is trading at 40. I'm making a loss. Of course, the position itself is benefiting because I'm holding the shares. What I plan to do is nothing. I believe the Larsen will continue to consolidate in this price range. And towards the end, if my call is in the money, I will roll it forward to the next month, the first part that I spoke about. If you have any specific doubts, like apart from this, I've tried to cover just a brief amount of things that can be done in case a covered call is bleeding to this extent. Look, if your covered call is bleeding to the extent that it is with ITC, either you have to overpower it or you have to just cut your losses or give delivery, basically. And if it is to a small extent, you can try to take additional put side credit. You can add a bull put spread, where basically, for example, to this Larsen position, a particular adjustment that I can make. Okay, so for example, this particular Larsen position, if shares would have benefited, so that's good, but now you're losing on the call. So one thing to do is, one thing you can do, depending on how aggressive or conservative you want to be, is the same 2 lots of call option that you short. You short the put option at the money, making an inverted triangle, increasing your upside break even, but now you also have a downside to worry about. If you are too conservative and you don't want any downside risk whatsoever, because you'll also have downside risk on the shares, you can purchase an out the money put option to make it a bull put spread, right? So you basically created a bull put spread at the money so that in case there is, you basically get more room on your upside and you have limited loss on the downside. The other thing you can also do is you can also completely decide to cut off your upside unlimited risk on this F&O position by buying an OTM. Making it basically at that point, if you do it in this manner, it becomes an iron condor. But you basically buy 2 lots of OTM calls so that your upside risk on the F&O position is capped, whereas the upside profit on your particular shares is unlimited. Technically, you're already in a deep profit on this position. So these are a couple of ways. If you're expecting IV to rise, you can create calendars. Though that is another way of managing it. You can just, if you don't mind dealing with, I mean, you can. One more thing is you can make this a short strategy, which is basically instead of selling at the money, you're saying out the money, right? Because now 1700 is out the money. You can sell 1700 put option. You can sell this two lots. Now it's become a short straddle here. And in case it continues to head higher, that put will anyway give up all its value. Your call is perfectly hedged. And later, as we reach the monthly expiry, you can square off the call and roll it forward or whatever in that manner. So, I mean, if anything, there are two things to take away from here. One, always have hedge trades, even if it's like really bad hedging, have some kind of hedging. Second, if your trade goes against you, most of the time, the best thing to do is cut it. Third thing is, when something goes against you, if you're not able to cut it, first thing, at least cut off the risk in that direction. You're bleeding call, buy a call. You're bleeding put, buy a put. After that, you can figure out how you can play around with that trade and try to come out of it profitably. But these are like a few things. You can also do other stuff, like, for example, you can create a broken wing butterfly structure. Now, broken wing butterfly, basically what you do is you sell an at the money straddle. You sell both these options. You purchase a hedge in the direction of risk that you're currently facing. You purchase a closer hedge there, and you purchase a much further away hedge on the direction where you are not losing. So what this does is basically, if you remove this call option, this trade will show you how this looks. Now it is taken as sell, is it? Okay, the buy. Okay, so what this does is on the upside it gives you limited profit, on the downside it gives you limited loss. In case there's a upside continuation move from where your current this thing is, you have at least some amount of limited profit that you'll be getting. It's a short 2 lots of call. I would in that case take 4 lots roughly, and this depends on you. This completely depends on how or what kind of risk reward you like and how you have this thing. So in conjunction to this current position, it would have given me some more room on the upside because I have some limited profit on the upside. I hope this was useful to you. Some trades are too far gone. You can't fix a trade that is gone against you. Eight times. The premium is trading at 8 times of what you sold it for. You can't fix such trades most of the time. So I mean, to do it, you basically require a lot of additional capital and whatnot. But I hope this was useful to you.
Thank you for watching. Please post any questions you have in the comment section. Also, do not forget to like and share the video and subscribe to the channel. To find us on Twitter, Telegram, and Facebook, use the username NiftyBN. Also, we post some of our trades to the community tab, so do not forget to check that from time to time.